continue to give our view of risk, which should be pretty consistent from our point of view and from the client's point of view. But it might be more in line with sort of what the market is then getting to. So I think that it will be interesting from different players that haven't got a consistent view of risk and have talked to clients about it. That might be awkward, but if you have a view of risk and that hasn't changed for Europe at least, it should be straightforward conversations. Really.
It's tough to earn your cost of capital as a reinsurer. We've had these big events in the US, these Atlantic hurricanes that have come through. But if you're a small regional mutual in Norway, or if you're a mutual company in France, and you haven't had a loss for quite a long time, if somebody comes to you and says, I'm not earning my cost of capital because of some Atlantic hurricanes and also because I just wasn't anyway, therefore you must pay more, it's an extremely difficult argument to have, especially when the cedent itself is flush with cheap capital. So if you're a cedent and you've got a solvency margin ratio of 150% on a Solvency 1 basis, you may be in the same range on a Solvency 2 basis if you're using the DSCR. And you have costs too. That's going to be the mitigating effect on rates going up a lot at 1/1.
Personally, from the standpoint where we sit on this, and again, I think it's worth remembering that as we go into this renewal season, the vast majority of business is already on 2- and 3-year deals. So actually, how much of the industry is going to renew at the 1st of January? I think that's a really key point.
That's true.
And doesn't, and from what we've heard, I mean, yes, we're seeing some pushback on terms and conditions, but I think that the growth of the ILS and the alternative market has brought a new discipline to the way that reinsurers look at it, particularly the effects of the retrocession market. And if anything, that's brought more stability to the industry by providing broader products, which in turn have resulted in the reinsurance market providing broader coverage.
Yes, it was about market consistency, and we have and the clients realize that there have been very, very, very soft market during all those previous years, and that risk assessment was already known to be not enough. And so all those losses that recently we get into just show the humility we should have in risk assessment. We always learn more with new losses, but these ones are quite heavy. There is also a climate change effect that is not taken into account in our pricing in a way. And I think it's a real momentum to change the landscape.
The question on what we will do through the retro market was defined yesterday by the CEO, Guy Carpenter, President Guy Carpenter, Mr. Nash, in the symposium as an unknown, right? I don't know what my competitors will do, but if Guy Carpenter doesn't either, it's starting to become interesting, right? And so for me, the question is, okay, we have excess capital, and we had excess capital. Some has been lost. A big chunk of what has not been lost in the capital market has been trapped, right? So if we as a sector don't reload exactly what is needed to renew what we had before, somebody will be left with a bit less capacity. And the question is whether once they had this less capacity from the retro market, whether they can keep their underwriting behavior completely unaltered. I would say, at least the way I look at it from my perspective, I wouldn't withdraw capacity proportionally across my retro book if I had a problem. I would actually choose a couple of players I'm actually looking forward to tell them no, because of their very soft market behavior when they had the upper end.
The sector is, or was, overcapitalized. We think to the tune of about 60 billion, with a solvency margin ratio of about 128% going into the catastrophes. We've had, let's be aggressive and say we've had 130 billion worth of insured catastrophe losses. Let's be aggressive again and say 65 billion of that is reinsured. You've got 22 billion of cat premiums. So you've still got some excess capital in the market. You mentioned trapped capital, and this is an argument that I've heard a lot of people make, but it seems like a lot of sound and fury without too much clarity so far, at least to me. There's definitely trapped capital pursuant to the fact that, on some collateralized covers, if you hit part of the deductible, then you have to wait until you get to the UNL before you can release the capital. But there are very creative products to release that trapped capital. We've got excess capital in the sector. You've got companies like Partner Re, who don't actually need to raise capital because you're owned by a large financial conglomerate and you can just write more premiums if you need to, because you've got that capacity behind you. Not to mention the Amlins of the world that are backed by Mitsui. Look at all of the Lloyd's syndicates and Bermuda companies that have been bought by these big conglomerates. And then if you look at the 2 cat bonds that we've had issued post the hurricanes, and I'm backing the numbers out here, so I could be wrong, and Luca will correct me, but they seem to imply, those two cat bonds that I've seen seem to imply increases, but reasonable increases.
At what point do they come back in, or do others decide to use more capital or to obtain more capital in order to write more business? And there's probably a tipping point about whether that's 20% up, or 25%. I mean, is debatable, but it's probably something closer to the 20 as to where, at what point would people really start to redeploy and come in with significant capital to support the market.
I agree with that, but I get a lot of pushback when I say that. But I agree with you.
Yeah, and I think you've got to be careful. My point of view just feels like you've got to be careful making these sort of generalisations, because some of the markets are more attractive. It won't take. We've got unstated capacity sat there already.
Yeah.
We don't have to worry. So domestic or regional reinsurance programs, it's not ILS heavy.
Mm-hmm.
Or not at all.
Yeah.
In fact, the traditional market is right there, and it's still a market.
Mm-hmm.
And the broker would say they wouldn't be, but
Yeah.
it feels like there's the access to capital. It's there already. You guys have just been. We're on the edge. So in individual programs, individual territories, a small change, in fact, it might be no change, would be enough to carry this renewal through.
If you look at the buffer loss table, an event which is 3 months old, you need to multiply losses outstanding NIBNR by 2, and then you drop, right?
Okay.
Now, I've seen the products out there that can release some, and I say, if you give me a bunch of third loss liquid collateral and you pay me X%, but okay. So it's not, if you are a retro heavy fund, I don't know how much liquid third event assets you have to back it out, right? So, the trap collateral will be, for me, the big question, the biggest unknown that can change is renewal at the end, right? And if at the end, towards the end of the quarter, people will have to sell cat bonds to be able to renew some transaction, the market may turn. So I'm personally not a buyer now, because I'm afraid of that correction. I don't know. It's not that I say there will be. I'm just telling you, I don't know where it could go.
It feels like 2004, and maybe a little bit of 05 sprinkled across the top, but we'll see as we get closer. So I sort of think the retro market's probably going to go up by about 25%, something like that, particularly the bottom end of those layers. And I think the cat market's probably going to go up by 10%. Happy to be proven wrong, because then my clients don't have to spend more money. However, as I think you move from the bottom layers, that increase will fall back significantly. As you get to the mid layers and the top, I don't think you've seen too much change there. Down in the bottom, and particularly if you've seen some action, you're going to see some price increases.
To use the banking analogy, most banks around the world don't earn their cost of capital either, and are valued at well below book value, and somehow it carries on. So how long can this carry on?
Well, this is, if what you say is true and that consolidation continues, then that will in effect be taking some capacity out of the market over the long term, definition of consolidation. And the other two things that can happen, of course, are interest rates and inflation. So if we think, we're going to be publishing a report here in a few minutes that shows the fourth quarter of 2016 was the first time since the third quarter of 2005 that the top 30 P&C insurers in the world had deficient reserves on a calendar year basis. First time it's happened in 11 years. We'll probably see more quarters with deficiencies, and then we will start to question the capital numbers themselves, because in insurance, capital is just a guess. The other thing that could potentially happen, let's hope, is that the economy could grow faster, interest rates could rise, and we could start finally making some money on investments again. But until then, you're right, consolidation, if you're just looking at, if you're using basic principles of corporate finance, then consolidation is the only answer. I'll just quickly finish up by saying the sub-themes of 2017, lessons learned. The lesson that I learned was that 13, 14, 15, and 16 were rather abnormal in terms of cat losses. The second lesson that I learned is that insured catastrophe losses globally are continuing to increase exponentially, and or almost exponentially, more than linear, and that is mainly because of increased insurance penetration.
At the last roundtable in Monte Carlo, there's a lot of theme about the market turning event. So if you think whichever estimates you deal with, we're somewhere between 80 and 100 billion. So maybe the market turning event, I think Monte Carlo is described as 120 billion.
Hey, what do you think about that, the 1 to 100? Because that's
No, hang on.
seriously, we always
I
talk
haven't
about.
actually finished.
I'm sorry, sorry about that.
So what is the definition of the one in whatever, right? Because it's a lot of the conversation is reloading back to the present point, right? What if the present point is moved on? Now we've got a two-dimensional problem. We've got correction in pricing and the elephant in the room, which is a correction in capital. What do we really need to hold?
Yeah.
And some of that was alluded. I think you were making that point earlier, right? So how do we deal with that? Because that's the real thing that we need to get in. So if we're going back to the market for capital, surely we should be talking about correcting in two ways, not just in
So
one
is it
way.
really a 1 in 100, or is it more like a 1 in 10?
I would say, yeah. I mean,
Yeah,
I can join here, maybe from AR's perspective. So, I mean, definitely, first of all, obviously, I mean, it's something very extraordinary. So this is a record-breaking hurricane season. So there's definitely something to be learned from this. I mean, we have been doing damage surveys to really look at the damages caused by the three events, and definitely there's a lot to learn. And the models obviously always need to improve. I think the models are always wrong, and they can just get probably better and improve, obviously. But from a return period, I mean, first of all, obviously it makes a difference if it's a single event or if it's an aggregate event or loss. So if this is aggregate and the number we see is not that, I mean, again, it might be whatever, 100 billion, it might be even higher. We will see. I think the claims from Maria will take a much longer time to develop over time compared to the others, at least compared to Irma. The thing is that the annual average loss we calculate, or you can calculate using AR models on a global scale, isn't that much lower than what we're currently seeing. So it's not that extraordinary, at least from an aggregate perspective.
So it's not, because you use the word extraordinary, and I was just going to say 3 Atlantic hurricanes is pretty normal, right? I mean, we have hurricanes on the Atlantic coast and the Gulf of Mexico. We've had hurricanes in Puerto Rico for a really long time. This isn't really that abnormal or extraordinary, right?
It is, I mean, the number of landfall, I mean, again, the number of hurricanes forming is high, but I mean, what is obviously different this season is that you have a large number of hurricanes that make landfall.
Yeah.
So basically what we have is a season where you have all the right ingredients. I mean, elevated sea surface temperatures we've been having for quite some time. But basically now other things come into effect, you know, that El Nino didn't kick in as much as it could have. The Atlantic multi-decadal oscillation was favorable for hurricane formation. The Bermuda High, which basically steers forming hurricanes to the west, etc. I don't want to go into too many details, but I mean it takes certain ingredients in order really to have landfalling hurricanes that make landfall in the U.S. And this is what happened this season. You know, this is really the the most active season since 2005, as we all know.
I think Noah had already predicted that whatever at the beginning of the year, but maybe our renewal season, you know, all the conversation should be in February or whatever, because at that point nobody's really listening. So the conversations were there. You can go to the site and they'll tell you that they're within whatever they said. What they didn't do was obviously describe the impact on the industry. And of course this season could have been a lot worse. It could have been a lot worse. So, you know, realistically we should be thinking about 120 billion isn't enough.
If you go back to Monte Carlo and that Friday and Saturday before, as we were going into it, there was such a different mentality or mood at that time in terms of how people were. You know. And I think just getting back to one of the points that you made, Bill, about where this industry is, there's still an enormous amount of capital that is wanting to come in, and whether you talk about what the MS admins look like and other people with Japanese wallets, or look at the Chinese appetite to come into the space, there is an industry that is already overcapitalised. There's still a lot of capital that's yet to come in and keen to deploy, and I think that's also going to sort of temper where people go with what the market will look like in the coming weeks and months.
If you take a 20-year view, is it fairly normal year, or do you think that it's outside of normal? And just to tell you my opinion, I think it's normal. I think it's normal that we have 3 hurricanes in the Atlantic Basin in a given year. I don't think that's all that
Is that the
abnormal.
new normal?
No, I think that's the old normal. If you watch West Side Story, in 1950, they were having hurricanes in Puerto Rico. This is something that just happened. It's something
What's the last
I'm just saying, it's not abnormal to have hurricanes down there.
In the last 10 years, it is.
No, but in the 1960s and the 1950s,
Yeah, but-
we had more hurricanes than we do
But
now.
that's the issue, isn't it? People's expectation period
Yep.
is getting narrower and narrower. So
That's true, but do you think that this is essentially normal in terms of a 10 or 20-year period, or is 2017, I mean, it is probably going to be the biggest loss year ever, but that's because in the 1970s, we didn't have hotels and commercial exposures in Puerto Rico. We do now, right? What do you guys think? Is it pretty much within the distribution, or are we having tails?
It is, I mean, it's within the distribution. I mean,
Yeah.
what we model, obviously, is we model 100,000 years, and if you look at our event catalog, you will find similar, years that look similar, like the year we're just experiencing. So it is not completely, whatever, out of the blue or black swan, so
Yeah.
to speak, like maybe, Tohoku earthquake was, where you didn't know,
Yeah.
or Northridge, where you didn't know where the fault line was before. So I would say it is within, expectations, but it's definitely an extraordinary season, I would say.